So things are looking real grim for Japan. Their currency intervention isn't working. They are burning through their reserves and now they are printing money to fight inflation. We have Japan unleashing a $200 billion stimulus plan to counter inflation. Yes, we have reached twilight zone economics where you do more of something that will ultimately cause higher inflation in order to solve the original inflation problem. Now, most of the money is going to flow into stimulus for household electricity and gas bills. Plus, we also have coupons for families with new bonds to offset the higher cost of living. Now, as noble as this sounds, this is going to expand the money supply in the country directly. This is basically the stimulus injection the United States did back during the 2020 lockdowns, and it resulted in soaring inflation a year later. Now, obviously, the magnitude isn't as bad as the trillions of dollars printed in the past, but it is not exactly a great move to solve Japan's problem long term. Even Japan's finance minister Suzuki knows that this isn't a good idea. He mentioned, "There's no doubt our response is making the fiscal situation more severe. We must conduct responsible economic and fiscal management." And this is very contradictory because, on one hand, you are preaching fiscal responsibility, but on the other, you are still spending 29 trillion new yen, and 80% of the stimulus is going to come from debt. We have to understand that this move is inflationary in the long term. You are borrowing money to solve inflation caused by the currency depreciation of the yen, and this is caused by the world selling off the yen because Japan refuses to hike rates. Now, Japan has always been in a difficult position. They have been trying to stimulate their economy for years by keeping interest rates low, but the banks are not lending, and the Japanese people, they are not spending. And because of this ultra loose policy and the stronger dollar, Japan's inflation is getting out of control. Yes, they wanted higher inflation to stimulate the economy, and now they are getting it through a currency devaluation. Now, the Bank of Japan, like all other central banks, they have a mandate to achieve price stability, and like the Fed, their target inflation is 2%, and they are doing it through yield curve control. That's a fancy term for selling and buying bonds to control rates. And guess what? Inflation is now at a 33-year high. Consumer prices have risen by 3.4%, which is a lot in a country used to low inflation for a long time. And this is likely going much higher because there are so many pots of gasoline being thrown at the inflation fire. We still have the BOJ committed to buying bonds, and this new spending by itself is going to inject new money into the economy. This is going to increase demand and keep inflation high. Plus, the Japanese yen is still not out of the woods yet. Once you get the inflation genie out of the bottle, it's very hard to get it back in without lots of pain. They haven't learned the lessons from the Federal Reserve. Now, the problem with this $200 billion stimulus is how it's going to be raised. According to the Japanese government, they'll be issuing 22.8 trillion of new debt. In other words, they are selling bonds to raise the stimulus money. However, we know that investors and funds, they are all selling off their Japanese bonds in record amounts. Just in September alone, overseas funds dumped a record amount of JGBs, almost $44 billion worth, because no investor in their right mind would want to buy the JGBs. It just doesn't make sense. Japan's benchmark rate is at negative 0.1%. We are talking about negative interest rates, and it is making their bonds look terrible. We can see the yields on the JGBs are horribly low. The 2 years at a negative yield, which means you lose money buying them, and the 10 years under 25 basis points. And if we contrast that with treasury yields, it is night and day. The 3 months is at 4% and the 10 years at 4.1%. So it doesn't make sense for investors to buy Japanese bonds when US treasuries are yielding much more. And this brings us to the issue of Japan's debt issuance. There's a good chance the majority of it is going to be absorbed by the Bank of Japan. This is in addition to the current bond buying spree they are doing to keep rates low. And this means the BOJ is going to print up trillions of yen to buy up the stack of government bonds and expand the money supply. This will likely cause a bigger inflation problem down the road. Ugh, investors are not going to touch Japanese bonds because it is not a good bet. And near zero rates, there's only one way up for bond yields, which is to go up. That will crush bond values down the road. So it's understandable why investors, they are running away from it, because if they buy now, it is virtually a guaranteed loss. And the markets, they have woken up. We have the 10-year JGBs untraded for record third straight month, and this will continue. As traders are putting it, Japan's 10-year bonds have gotten expensive because yields on other notes have risen. No one is interested in trading such bonds. And this higher inflation is going to eat away at the Japanese yen. We know Japan has been draining their dollar reserves, spending a record 42 billion in October to rescue the yen, but it is not really working. The yen is still down 21% versus the dollar, and it's very likely this move down isn't over quite yet, because we need to understand the motivations of investors and how they are going to perceive this stimulus spending. Because what we have now is both monetary policy and fiscal policy moving towards easing. We have the BOJ spending money to keep Japanese bond yields low, and now we have the Japanese government spending tons of money to fight inflation. So in other words, we have double money printing going on. It is an investor's nightmare, and they're going to continue dumping the yen and moving into dollars, the perceived safe haven. And that is why we are already seeing an exodus of money leaving the JGBs, with over 560 billion yen flowing into US treasuries from Japanese funds themselves. And this is where we need to talk about the yen carry trade, because the biggest winners are the currency speculators. Traders who are betting against the yen and going long on the dollar, they are winning big time. So the yen carry trade is a strategy where investors borrow yen at low interest rates and then purchase US dollars to invest in treasuries that pay a higher yield. For example, you borrow yen at 0.25%, you sell those yen for dollars and buy treasuries that yield 4%. So now you have locked in a 3.75% gain on the interest rate for low risk profit. And that means if you're betting on the yen carry trade, you want Japanese rates extremely low and US rates in the sky for the widest interest rate differential possible. Plus, you also want both currencies to remain stable so there's no currency risk. But guess what? The trade works even better today. It has been incredibly profitable because of a perfect storm in the currency and bond markets. The yen has been crashing while the dollar has been appreciating. And that means the yen you borrowed a few months or a year back ago is now much cheaper to pay back. Not only have you locked in your interest rate gains, but now you also have additional gains on the currency side. And because Japan is committed to keeping rates low to stimulate their economy, and with the Federal Reserve still hiking, this interest rate differential is going to continue widening. We can see since the start of 2022, the gap is widening fast. It is already over 3% today, and it will only get wider. So this yen carry trade is going to keep Japan in a perpetual currency crisis, because now it is even more lucrative to borrow Japanese yen and sell them on the open market for US dollars to buy treasuries. This is going to add more strength to the dollar and continue weakness for the yen. It's a self-fulfilling prophecy, and it all stems from the fact that Japan once again refuses to raise rates while the Federal Reserve is actually playing it right by hiking to protect the dollar. And that's why we are going to continue seeing more interventions by the BOJ to keep the yen on life support. They are going to sell more dollars and drain their reserves even further. And according to JP Morgan, they are predicting that Japan's central bank will do another large-scale intervention if the dollar accelerates to a new high beyond 152 yen. And they also believe that Japan can't keep this up forever. Remember, a Plaza Accord to save the yen isn't very likely. The US is rejecting the idea, and they're going to keep allowing the dollar to appreciate because it allows their imports to be cheaper. Japan is truly alone in this currency fight. And here's the big question: how long can the BOJ defy gravity? How long can they keep this currency battle going? Because sooner or later, one of two things is going to happen. The first is draining away their entire dollar reserves, which is disastrous. This will make them ultra vulnerable to supply shocks. If another conflict breaks out, or maybe OPEC decides to cut production more, Japan won't have enough dollars to import commodities, especially food and fuel, into the country. Now, the other option is just as bad for the Japanese economy, which is to raise interest rates. Even Kuroda is about to crack, hinting that he might have no choice but to raise rates down the road if inflation picks up, which it likely will. And when rates go up, we could see a bond market implosion like in the UK. Remember, Japan is used to operating in a zero interest rate environment for at least 6 to 7 years. The government could borrow money at low rates, and we have no idea how much leverage is in the system tied to Japanese bonds. God knows how much money the bond vigilantes are also betting against the JGBs right now. So there could be pressure building under the surface of Japan's bond market, and it could be magnitudes worse than the UK situation. So Japan is caught. I believe they will raise rates sooner or later, because if they don't, the yen is going to keep plummeting to hell, and demand destruction is still going to happen because now the currency can only import less stuff. And this is the real concerning part. If we look at Japan's stock market, the Nikkei has only dropped by 5% compared to the S&P, which is down 20%. But that is not true strength. It has been artificially propped up by low rates from the Bank of Japan. Even the US market is showing more genuine strength than Japan because rates are already going up and demand destruction is already happening in America. Now just imagine once rates starts to rise in Japan, how much more will the Japanese stock market continue to crash? Because if rates take down the Japanese economy, we will likely see another lost decade in their stock market. Investors will run away from the Nikkei like the plague. Now if we zoom out, we can see over the last 40 years, Japan's stock market has only increased by 15%, while the S&P is up 2,600%. Japan has experienced 40 years of stagnant growth, at least in their stock market. And this is the problem of trying to solve structural problems such as an aging population through monetary policy. You can't print your way out of every problem. Investors are right to be very worried because Japan is the land of central bank intervention. I don't think we have seen such yield curve control to such a degree before, except from the Federal Reserve. Even the equity markets in Japan are propped up by the BOJ. They are the biggest shareholder of Japanese stocks, holding over $400 billion worth because no one wants them. Even the Federal Reserve doesn't dare to mess around and buy up US equities because they know there is a line too far. So Japan isn't in the best shape, and we need to watch the BOJ because sooner or later, I believe you have to hike rates, and that could take down the Japanese economy. So let me know what you think. Will Japan pivot and raise rates, or will they drain their reserves to the last dollar? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these inflationary times.